This will be a boring video if you are not interested in Rash or if you don't believe an individual investor can crush the markets. Also, there won't be much with the visuals. I will occasionally be showing some graphs and some data, but from now on, the channel will be closer to a podcast as it saves me an enormous amount of time while I can still provide what I hope to be valuable insights to you. So, as I wrote in the title, currently around 70% of my portfolio is in Rash. 60% of it is in the logistics and 10% is in the REIT. As a reminder, the logistics owns 61.94% of the REIT as well. Monish Pabrai is how I first heard about Rash, so yes, it is 100% a clone position for me. I wasn't unfortunately smart enough to find it on my own, but I can say I was smart enough to clone him early enough, because I first started buying Rash in under $100 million valuation, and I bought as high as $800 million valuation as well. So it is already a multi-bagger for me, but I'm not even considering trimming at these prices. Monish, as you know, started buying at $20 million valuation, so it has been as high as a 40-bagger for him already. So what does even Rash do? It is actually a very simple business model. The REIT buys plots, builds warehouses and rents them, while the logistics does, well, logistics. It doesn't get any easier than that. I will not be diving into the nitty-gritty of the business here. That would make the whole video 5 hours long and it would take me a month to make it. While I will not be going over everything, let me just give you a recent example. In first quarter of this year, Rash GAO, the REIT, has purchased a land for 175.7 million liras, which comes down to around $5.5 million with the exchange rates at the time the deal was announced. There is already a factory building there, but they said they will build a factory building and rent it for $2.5 million a year starting in 2025. So let's say they spent around $2 million more on construction, and then they will be renting it for $2.5 million a year. That means around a roughly 30% return on capital. That is just one of the many examples throughout the years where they are announcing similar deals. Their rental income goes up every year in dollar terms, and all while they are still not even half of their liquidation value, of course in my opinion. By the way, all of these are public information. Rash releases these documents on CAP in Turkish. And as a Turk, I obviously read them and do my best to cover the news in English. But you can also use Google or ChatGPT for the translation yourself as well. I dive much deeper into every update and the business on my Patreon. And not only Rash, I also cover CCI, TAV Airports and FS as well. I already published a lot of content there, hundreds of pages. You can subscribe now and gain access to all of them. The link is in the description. I wanted to make a video where I talked about having a company making up 70% of your portfolio, because I look online and I see a glass ceiling of around 20% of most people's portfolios where they start finding reasons to trim, worrying about being too concentrated. And as a Buffett and Munger disciple, I don't think it is a very smart way to invest. Of course, it's their own money and who am I to judge? But I believe that if Buffett had only a couple $1 million to invest right now, he would probably have a handful of positions. Even at the current size, the equity investments on Berkshire is very top heavy. Another example is Nick Sleep. He too had 70% of his portfolio in one stock, and it was Amazon for him. The only reason he trimmed was that Amazon was getting literally too big and had to add not even hundreds of billions but trillions in market cap to double. And even at that point, Nick still said it was probably a mistake to trim Amazon. Currently, as I mentioned, Rash is at only $800 million market cap, and obviously I don't expect them to be at the size of Amazon, but there is nothing stopping them to be one of the biggest companies in Turkey in the future. Size won't be a problem for a long time. So what else? I mean, not every small cap companies end up being multi-baggers. What else is different in Rash that made me put 70%? At a first look, you will see a company that is trading less than half of its liquidation value. An easy cigar butt. But that's not the story. As we saw with the example I gave earlier, they are investing their capital at 20%, 30% returns. That is an incredible level of capital allocation, and the moat of the business, in my opinion, is incredibly deep. And there are lots of tailwinds behind the company. They are not over-levered like some of the Chinese real estate companies. In fact, they are not even levered per se. The balance sheets of both companies are, in my opinion, incredibly safe, which is unlike many REITs. And as I said, I dive deeper in each of these aspects on my Patreon. But you too can do your research, like just read the reports and you will see. I mean, no matter how I look at it, I see no reason to sell or not even to stop buying. I am still buying regularly and I have no plans to sell or even to trim in the future. One final similarities I see in Rash that reminds me of Amazon is how little they cared about the noise from the stock market compared to the business side. This famous Amazon.bump cover from Barron's explains it all. Investors and analysts of Amazon famously wanted the company to start reporting positive earnings, but no matter what they did, Jeff Bezos just kept investing back into the business. Same with Rash. They could have easily paid dividends, and the family that runs the business also owns huge amounts of the stock as well. They could have just collected the rents, do their shipments, and pay themselves hefty dividends. But they did not, and they still are not. They are building more warehouses, buying more trucks, investing in new markets. And after this point, I will probably just keep repeating myself. So rather than that, I will just give you the bullet points. A family-owned business, growth-oriented, healthy balance sheet, less than liquidation value, and competent capital allocation. So what is the hair on it? It is trading in Turkey. But the international firms like Mercedes are paying Rash in euros, and Turkish firms' deals are pegged to inflation. Even the Mercedes deal is pegged to euros inflation. So finding a company like that, I believe it is a fat pitch that I just couldn't miss. I had to strike, and I striked hard. It is 70% of my portfolio. By the way, I know nothing of baseball, so I hope I didn't screw up Buffett's analogy. Over my lifetime, I will consider myself very lucky if I find 5 ideas like that. And I'm not even 30. So that was it for today. If you believe you have another fat pitch, let me know in the comments. If you want to support the channel and get access to the deep dives, updates and tracking tables regarding these 4 businesses of Rash, TAV Airports, CCI and FS, please consider subscribing to my Patreon. The link is in the description. Just click the link, look at the content, and if it interests you, try it out for a month. And this month, we will get the second quarter's earnings as well. I will cover the earnings, along with the recent purchases, rental agreements, and so forth. I will release the update after the earnings report is out. And I'll see you in the next one. Bye.